Welcome to the TValue 6 video training series. Today we're going to show you how to do an interest rate change during the term using TValue 6. So let's look at our example. We're going to do a loan of $300,000, a mortgage. We'll have a term of 30 years. We're going to have an initial rate of 3%, sometimes called a teaser. And then after 2 years, we're going to adjust it to 4%. And then after another 2 years, we'll adjust it to 5%. Mechanically, we're going to show you how to do the calculation. You can use obviously any type of scenario to do that. So let's jump over into TValue 6. And it said interest rate changes. Our compounding period will be monthly since our payments are monthly. We're going to start with a 3% rate. Whatever the initial rate is on day one is what goes into the nominal rate, and then we'll show you how to do rate changes after that. And we'll use the date here. I'm going to put a loan of $300K in. You can put the K for zeros, a shortcut within the program. The number is 1. We only have one loan. Jump into line 2. We'll have a payment 1 month later. We're going to put U for unknown. And the key to doing a variable loan is always to structure the number or the remaining term to determine what the payments are. So we're going to put in 360, so that's our original term. We're going to hit calculate, and our payments are going to be $1,264.81. But we said we're only going to have 2 years of payments, so we're going to change the 360 to 24. We're going to go to line 3. We're going to hit rate change. We can either hit R or hit the drop down, and you'll see the date got backed up to the end date. That's because that's when the interest will start, and any subsequent payments will be at the new interest rate. We'll go ahead and change that to 4, and now we got to create our payments. We'll go here, put U for unknown. We already have 24. We started with 360, so we have 336 remaining payments. Go ahead and hit calculate, and now our payments are $1,422 because that's at the new interest rate. But we're only going to have 24 of those. And now we're going to go to line 5. I can hit R once again for rate change. We're going to change the rate to 5% and go back to line 6, put U for unknown, and then once again we're scheduling line 6 over the remaining term, which will be 312, and hit calculate, and our payments are now $1,580. We can go to the amortization schedule and see that here's our detail of all our rate changes and the payments, and you'll see here the payments are $1,264. You'll see the interest here is $700. Then we had the rate change to 4%. Our payments went up as the interest rate went up, and we can look 2 years later at 5%, and then we kept it that remaining term. So very simple to do. Once again, you always want to structure the remaining payments over the remaining term. If you ever have any questions or need any help, always feel free to reach out to us at TimeValue.com, phone number 800-426-4741, or you can email us at info@TimeValue.com. Thanks for listening.